Hi there. In this video, we explain when the Domestic Reverse Charge VAT rules do not apply and what UK construction businesses should check carefully.
The transition is over. As of April 2026, the light touch period for VAT domestic reverse charge compliance has officially ended. HMRC has pivoted to a regime of immediate, high-stakes enforcement. Misapplying these rules now carries a direct financial penalty. Beyond the standard tax assessments, HMRC is empowered to impose personal penalties on directors for up to 30% of the tax lost through incorrect reporting. HMRC's focus extends to the viability of the business itself. Compliance teams are now empowered to cancel a company's gross payment status instantly upon identifying links to fraudulent or erroneous supply chains. Without gross payment status, a company's ability to receive gross payments vanishes. In the current market, this single administrative failure can force the collapse of a Tier 1 contractor or developer. The Domestic Reverse Charge, or DRC, is a fraud prevention tool. It removes the opportunity for missing trader fraud by shifting the output VAT responsibility from the subcontractor directly to the customer. Most construction firms operate under a dangerous assumption. They believe that if both parties in a contract are VAT and CIS registered, the DRC must apply. This overlooks the vertical logic of the tax. The DRC is designed to push VAT liability up the supply chain, meaning the compliance risk inevitably pools at the very top with main contractors and developers. The problem is that commercial intent does not dictate tax treatment. Being the final consumer of a building in a business sense does not remove the reverse charge requirement without specific legal intervention. Surviving an HMRC audit in 2026 requires more than just CIS registration. It requires knowing precisely where and how to legally stop the reverse charge from flowing upward. The DRC is a binary mechanism. It only activates when exactly 5 baseline conditions are met simultaneously. Both parties must be UK VAT registered, within CIS scope, and providing standard or reduced rate services. The supplier cannot be an employment business, and the customer must not be an end user. If one variable is missing, the transaction reverts to standard VAT. To manage this, we have to map how this liability travels through a standard construction supply chain. At the base, a labor-only subcontractor invoices a main contractor. Conditions met, the reverse charge applies, moving VAT liability up the node map. The contractor then bills the client. Liability continues its ascent, pooling at the final links, landlords and retail tenants. This vertical node map allows a business to pinpoint exactly where the reverse charge liability stops. The most common way to stop this flow is the end user exception. An end user is a VAT and CIS registered business that consumes construction services for its own use, rather than selling them onward. Take a national retail chain building a new supermarket. Their business is selling groceries, not construction services. While they are the end of the chain commercially, they are not automatically the end of the chain for VAT purposes. The DRC liability continues to push into their node until it is legally deactivated. This is the notification trap. End user status is optional. It is legally dormant until the customer proactively claims it. You cannot rely on a customer's business profile. HMRC requires formal, written notification. Without it, the supplier cannot charge standard VAT. The declaration must be explicit. We are an end user for the purposes of the VAT reverse charge. Issue us with a normal VAT invoice. If a supplier does not have this written proof in their records, they are legally required to apply the reverse charge. Without this single sentence in writing, a compliant business remains a significant, unprotected tax risk for its suppliers. Many modern property structures involve intermediary suppliers. These are businesses that resupply construction services to a connected end user without making any material changes to the work. To qualify, the entities must meet one of 2 legal tests. The first is a property link, where both parties share a relevant interest in the land, such as a landlord and tenant. The second test is corporate. The entities must be part of the same corporate group as defined by the Companies Act. Consider a landlord procuring work for a retail tenant. Because of their relationship, they share a relevant interest in the land. This connection allows the landlord to act as an intermediary, issue a written declaration, and stop the reverse charge. Intermediary status provides the specific legal framework for holding companies and joint ventures to align their VAT treatment with the final end user. There are also structural overrides, scenarios where the nature of the work itself bypasses the DRC, regardless of the parties involved. The most significant override is zero rating. If a supply is zero rated under standard rules, such as work on qualifying new build residential housing, the DRC is deactivated. Because the DRC only applies to 20, this is a supply of construction services. It falls squarely within the domestic reverse charge. Contrast this with an employment business. They provide access to individual workers who operate under the direct supervision and control of the customer. This is classified as a supply of staff. Employment businesses are excluded from the DRC and must charge standard 20% VAT. HMRC audits look past the contract labels to determine who actually controls the work on site. Misclassification here leads to immediate VAT assessments and deeper investigations into payroll models. Correctly identifying the nature of the workforce is essential for accurate VAT reporting and maintaining gross payment status. In 2026, compliance is not a matter of intent, but of systems. Your first priority must be a historical audit of transactions from 2021 and 2022. You must identify and correct errors before the 4-year statutory window for VAT recovery closes. Billing and ERP systems must be updated to handle the logic of the DRC correctly. Software must be programmed to automatically flag zero-rated residential work and calculate the 5% disregard rule on all multi-service contracts. Finally, standardized notification wording should be integrated into all master service agreements. This provides the audit evidence required to justify standard VA charging. In this environment, survival requires hard-coding DRC compliance into your daily operations. The domestic reverse charge is a rigid system. End user and intermediary exceptions provide protection, but only if they are activated by formal written notification. If your business requires a supply chain audit, a contract review, or protection of your gross payment status, contact Atlas Tax Advisors today. This video provides general educational guidance based on 2026 UK tax law and does not constitute formal tax or legal advice.